Hello, everyone. Welcome to this webinar on tax basics for creatives. Today is February 6th, 2024, and we're going to talk about all we need to do to cover for taxes for this filing season, because that's our goal tonight, to make navigating tax season a little bit easier on you and your loved ones and anyone else who is navigating this entirely too complex system in the United States. More specifically, we're going to talk about specific 2024 changes. And if any of you have LLCs or S corporations, we are definitely going to make sure we are covering one new important change for that. So we'll make sure we're talking about that. We'll talk about the overall income tax landscape. We will talk about those ordinary and necessary business expenses that you will want to be deducting if you are running a creative business, and then we'll talk record keeping as well. So it's a lot to cover, but there's plenty of wiggle room in there for your questions. I will keep an eye on the chat as we go through everything tonight. So definitely please make sure you're putting your questions there. You can also use any of the emojis if you do want to raise your hand or come off mute or anything like that so that we can make sure everything is covered. So with that, if there is something specific you want to cover, now's the time to add it in to the chat. I know we want to talk about tax deductions for sure. That's something I definitely heard in the preamble, but if there are other things you want to put in the chat, please do not hesitate. After all, this is your time. I'm Elaine. I use she, her pronouns, and I am joining you from Columbus. I'm on Kashkashi and Hopewell Indigenous and Cultural Lands, and I am a CPA by training. I am also a personal financial specialist, which is sort of the retirement and long-term financial planning piece of accounting world. And I am an accredited financial counselor, which is sort of the human piece of all of this that comes into play, especially as we are navigating some challenges that go along with running a creative business, being fully human, being creative individuals, all of those good things. I am absolutely the luckiest money person of all time because all I do is hang out with creative people and talk to them about their financial problems all day long. I partner with amazing art supporters across the country. Hopefully you have gotten funding from some of these groups, or these groups are on your target list to get funding from in the future. I think I just saw Creative Capital just reopened this year's application portal, which is a great resource for creative individuals. So I get to just hang out with the coolest creative people all around town and around the country. And then, of course, I work with governmental groups, state arts councils, sort of regional bodies overseeing things, and then educational institutions as well. I don't think we can have these conversations too often. So yeah, and Mitch is here representing Maryland. I love that. Maryland State Arts Council does incredible things. They've got a lot of great resource, as does the Ohio State Arts Council. As we're going through all of this information, please make sure you are taking the space you need to make sure your questions are answered. That means using the chat, raising your hand, using emojis, whatever you feel comfortable with doing. We want to make sure you're taking care of that. And also, please make sure you're making space so that other people can have their questions answered as well. We want to make sure there's room for all voices. I don't mind a little bit of a pause too. So some folks take maybe an extra beat or so to collect their thoughts. That is totally fine. Take the space you need and make space for others as well. Don't feel like you have to rush to fill the silence. I also think it's important to say that we are all equal parts teachers and learners in this space. You all are bringing tremendous expertise, experiences, perspectives to this conversation, and all of those have value here. So want to make sure you can bring those forward. And if you have a great accountant, or you know of a really wonderful resource, or you have a favorite record keeping system, please feel free to share those in the room. You have, as I mentioned, lots of great experiences you are bringing to this conversation. And of course, we do want to make sure that if there are stories or questions that are shared, we want to make sure that we sort of protect the confidentiality of this space. It's not perfectly confidential, and we are recording this, but please respect the confidentiality of the space and let individuals share their own stories. But by all means, take any lessons you might learn from any of these stories and carry those lessons with you as you continue back to your studios or your performance spaces or your writing retreats or any of the creative places where you make work. Although I am a CPA, it's important to say that all of this information is being provided for educational purposes only. This is not intended to be used as tax, legal, or accounting advice. So definitely know that these laws are nuanced, and we'll talk through a whole lot of things as part of this conversation, but this is only educational. So I want to start out by talking through a couple of things that are new this year and draw your attention to some of those things. And some of these are regular changes that you may have gotten used to experiencing most years. So the first one is the retirement contribution limit. We know we have until tax day to make contributions to individual retirement accounts, or if you have a retirement plan through your business may make contributions on your behalf through tax day. So that individual retirement account limit for 2023 is $6,500. Or if you are over the age of 50, you have an extra catch-up contribution. You can make a contribution of up to $7,500. And that counts for the 2023 tax year. I know 2023 is over, but you have until tax day of 2024 to make those IRA contributions. So as your numbers shake out for the year, this can be a really great way to reduce your taxable income through a traditional IRA contribution, or to make a Roth contribution if you don't necessarily need the tax deduction for 2023. If you've been doing this a minute, you'll notice this number is a little bit higher. The contribution limit has been set at $6,000 for quite some time, so it was nice to see it nudge up a little bit for the 2023 tax year. The other thing that nudged up are the standard deduction amounts. Now, every human that files a tax return in the United States is able to claim something called the standard deduction. And the standard deduction reduces your taxable income by a prescribed amount. And that prescribed amount is tied to your own filing status. So if you are a single individual filing on behalf of yourself, your standard deduction for the year is $13,850. If you are married, filing jointly with your spouse, you get twice that amount. Why? Because there are two of you listed on that tax return. So that standard deduction amount is $22,700. If you're married filing separately from your spouse, you each get your own equivalent to the standard deduction. And lastly, if you are the head of a household, which means you are not legally married, but you do have a dependent you are caring for, your standard deduction is $20,800. Usually, these numbers nudge up annually in alignment with inflation, more or less, and we saw that to be true in 2023. The last sort of regular expected 2024 change has to do with the standard mileage rates. Again, these are updated usually annually, and for 2023, the standard mileage deduction rate is 65.5 cents per business mile driven. I've given you the 2024 rate here as well in case you are writing contracts or starting to track things for 2024. This number has nudged up to 67 cents per business mile driven for this year. So those are sort of the normal standard changes. The next thing I want to draw your attention to is something called a beneficial owner information form that's now being required by a group called FinCEN. And that's a whole lot of acronyms and a lot of information. And this is going to apply to you, and it is a brand new requirement, and it is going to apply to you if you have an LLC or an S corporation. So you'll definitely want to pay attention. So let's start with kind of some of these definitions. FinCEN stands for the Financial Crimes Enforcement Network. This is a newly created body that's part of the US Treasury. So it's part of the federal government. And BOI stands for Beneficial Ownership Information. And this group has defined a beneficial owner as being someone who controls a company or owns 25% or more of that company. And so if you are the only owner of your LLC and you do not have anyone else calling the shots for your business, your LLC has one beneficial owner, and that is you. If you are in a more complicated ownership structure, maybe you own an LLC with several other individuals, or maybe you have some sort of outside governing body, your beneficial owner identification process might be a little bit more complicated. But for most of the creative folks I work with who own their own LLCs or S corporations, it's pretty straightforward. The beneficial owner is the person who controls the company and or owns 25% or more of that company. So here's what's happening. FinCEN is requiring businesses to report information to FinCEN about their beneficial owners. And they're doing this as part of an anti-money laundering legislation process that basically is trying to help FinCEN identify the humans behind all of these different companies, right? So it's a really good thing in theory, right? We are all, I think, against money laundering in general. And one way that FinCEN has decided to counteract money laundering is by requiring companies, primarily LLCs or corporations, but really all companies, to report information about who their owners are. Now, the reason this is a challenge is that there's a lot of confusion around this. It's brand new. It just became into effect on January 1st of 2024, and there's a lot of confusion and misinformation out there. So the first thing is just to figure out if this even applies to you. In general, if you have an LLC or an S corporation or any other type of business, it probably does apply to you. If you are a sole proprietor, it probably does not apply to you. The one exception is if you had to file paperwork with your Secretary of State in order to sort of make your sole proprietorship exist. That is not normal. That's generally an exception to the rule. And if you're in the state of Ohio, you are not required to file paperwork with the Secretary of State. So this does not apply to you. FinCEN has also confirmed that getting an EIN, or if you registered a fictitious name, or if you are doing business as a different name, that is not enough to trigger this filing requirement. They really are focused on actual companies, corporations, or other entities that were formed and identifying the humans behind those entities. I will draw your attention to the frequently asked question resources from FinCEN. They really are pretty fantastic, and they're being updated on a regular basis. So that's where a lot of this clarifying information has come from. So if this does apply to you, you have a form to fill out, and it really is not complicated. It should take you probably around 10 minutes or so to do, but it is a little bit of an annoyance, right? What you need to do is complete this form that basically identifies the owners of your company. And you have to complete this before December 31st of 2024, unless you formed your company this year. So if you formed your company after January 1st of 2024, you only have 90 days to file this form. Now, hopefully, whoever helped you form the company, whether you had an attorney or you were working with an SBDC or something like that, gave you a heads up about this. But as I said, it's new and there's not a whole lot of sort of awareness around this yet. So if you've had your company for a minute, you have until the end of the year to file this. If your company is newer, you've got 90 days. Here's the other thing, and I hope you just sort of plant this in your brain and remember it. If you move, right? So let's say you report your ownership information of your LLC, and then 3 or 4 years from now, your home address changes because you move. You're supposed to update that information with FinCEN. Why? Because again, they're trying to identify the humans behind the businesses. So if your human information changes, and they're generally asking for your home address and some sort of form of identification plus your name, then you're going to want to update that information in their database. And you only have 30 days after you move at some point in the future to update this information. The resources on FinCEN's website are really good. There is a link to specifically small business resources, and you can just read more about this on FinCEN's website. It is FinCEN, FINCEN.gov. Couple of other things. There is no fee to complete this form, and we've already seen scammers try to like swindle people into paying fees so that they can sort of do this. Don't fall for that, right? It's a great idea to consult with an attorney if you have one, or if you have an accountant, or you're working with a tax person this year, they'll probably bring this to your attention. That's a really good use of their time and expertise. The form, it really is pretty straightforward. It shouldn't take you more than 10 or 15 minutes to do, and the information will not be publicly available. Having said that, it is information being stored in FinCEN's database, and it will be accessible by what they say is certain government officials and financial institutions. So if you're curious about that or want to learn more, watching those frequently asked questions is where they're providing a lot of that clarifying information about who will access the information and how. It is good that it is not generally publicly available because, as I mentioned, you have to share your home address and your form of identification. So that's something that feels a little dicey if it's just going to be readily accessible to all. If you are someone that runs a not-for-profit entity, this requirement does not apply to you. Nonprofits are generally exempt from this reporting information, so you do not have to worry about it, which is a good thing. And then this is the part that is getting some extra misinformation out and about in the interwebs. It is really punitive to not comply with this. The fines kick in after December 31st of 2024, and the fines are $500 a day for not meeting this requirement. That's a big number. It can get really big really quickly. So this is not something you really want to completely ignore, but it's also not something you want to really panic over. What I keep hearing is that most folks are going to be doing this as part of their tax filing process for the year. So put it on your radar, talk to your tax person about it. Maybe even if you're using tax software, see if it comes up there. And if it doesn't, maybe by like March or April or so, go ahead and take care of this. I will pause here. I didn't see any questions come through the chat, but this is sort of a new and interesting fun wrinkle to this year's tax season. So if you do have any questions, I'll be happy to address those. Just in case you're typing, I'm going to keep an eye on this, but also not kind of belabor the issue too much. So let's dive in further into sort of the big overarching question for tonight about how federal income taxes work. So in general, this is a simplified presentation of what federal income tax world in the United States looks like. And this is the Form 1040, that you will use if you are a permanent resident, a dual citizen, or a U.S. citizen. If you fall into a different category, like a non-resident, or you have some other status, you will file a similar but different form. And there's a link here to more information on those various forms from the IRS. But in general, it starts out with some human information. Then we report income net of business expenses if we're reporting business income. And then we reduce our income by adjustments and the standard deduction. And then we calculate the tax. So that's sort of the very simplified version of what tax world looks like. And if you are someone working in the arts, it's important to understand the type of income that you have, because you probably have multiple different types of income. And depending on what type of income it is, it goes in a different spot on your tax form. So as we're thinking about this income, generally, folks have income that falls kind of into these three categories. The first type is just W-2 income or wages. This is income where you are an employee of someone else. They are paying you on some sort of regular basis, and they are withholding taxes from the amount they pay you. You are their employee. That income is very different than any type of self-employment or business income you might have, which could be reported on 1099s, or it could be something you track by yourself within your business. It's also possible you have income that falls into like this other category. That could be like the dreaded hobby income that we think of, or income that isn't really a business you're running, but it's just something random you get occasionally from time to time. Mostly, though, W-2 income and then business income are the two main categories we see in the arts. And from your perspective, it might feel like you're doing the same work, but you might be paid in different ways, depending on how the entity classifies you. So if you are an employee, you get a W-2 at the end of the year. You have withholdings. You specify your withholdings to your employer on something called a W-4. And this is the most important part, you are not allowed to claim any business deductions related to this income. In contrast, if you are running a business and you are collecting or earning income as part of that business, there are no taxes withheld on what amounts people pay you, and you are able to deduct any ordinary and necessary business expenses you have as you produce that income, right? So two very, very different scenarios. Often what we see is if you have W-2 income, it could be as a teacher, for example. Maybe you are paid as an employee of a college or a university as an adjunct instructor, right? They'll withhold taxes and you are not allowed to claim any deductions as part of that income, right? So if you provide supplies to your students or commuting to and from campus, none of those expenses are deductible. But if you are running a business and say you are paid by attendees of a workshop that you are leading, right? In that case, you are not a W-2 employee. You are simply collecting income from participants. You have earned income. And in that case, you would have deductions for the supplies or materials you are providing to your classroom participants. So it's important to understand kind of what the classification is and how it affects your deductions. There's a great question in the chat about S corporations. S corporations are amazing because they are business entities. And what's special about the S corporation is the S corporation is required to pay its owner reasonable compensation on a W-2. So the way that works is the business owner has W-2 income, but all the business deductions live within the S corporation. So when you get paid, the income goes into the S corporation. The S corporation has its ordinary and necessary business deductions. And then among what's left, the net profit, some amount is paid as a salary to the owner of the S corporation, but those deductions still live within the S corporation. The individual can't claim them on their own tax return. They instead go on the S corporation's tax return. I hope that helps. It was a great, great question. So those are the main distinctions, right? We definitely want to make sure that if you have W-2 income, you are aware that you cannot claim business expenses to reduce that income. All of your business expenses live within the business income section of your tax return. So I have this example that's going to sort of govern most of our conversation tonight. And we're just going to walk through it in pieces and then dive into these pieces just to kind of understand what's happening where. But there are a lot of numbers here, and it's kind of representative of what it looks like from a typical artist perspective. Maybe not typical. These numbers might be a little bit bigger, but this person does have some W-2 income. There is some withholdings. They're running a business. That net business income gets added to their other income, and then we make some adjustments to get down to a taxable number. But where I want to start first is in this sort of sales section, right? You'll see a lot of this is captured on the tax form we call Schedule C. And this person is making sales of $65,000 during the year. They have business deductions of $18,700, and that puts them at a net business income level of $46,300. All of which is lovely, but it brings us to the question, are you really running a business? And for this person, I think the answer is absolutely clear, given the volume of activity they have. But the IRS asks us to look a little bit deeper as we're answering this question. And the first factor we would look at is, do you approach the activity you're doing professionally? And do you keep books and records? Keeping track of your income and expenses for the business is one of the most important things you do to demonstrate that you are, in fact, running a business instead of doing something just for fun. There are other things you can keep track of too. Maybe you have a business plan that you are updating or checking in with. Maybe you keep track of customers and you have some sort of, customer database, or you're managing communications with your customers in that way. There's sort of a wide variety of additional things you can keep track of. Inventory probably falls in this category as well. But income and expenses tend to be the main things that go into these books and records that you are keeping. So as we think about sort of more specifically what that means, the IRS says you can use any system suited to your needs as long as it shows your income and expenses. So it can be digital, it can be a more analog system. You can update it frequently or a little less frequently, depending on the rhythm of your practice. But it is important that you are keeping track of things in some sort of system. Within that system, you want to make sure that the system, whatever you're using, is capturing 4 key pieces of information. You want to make sure for every transaction, you have the date of the transaction, the counterparty, so who did you pay or who paid you, the amount of the transaction, and the business purpose. And in general, the date, the counterparty, and the amount are all going to be captured on the receipt or maybe your credit card statement. So that information is pretty easy to get and retain. It's this business purpose that you generally have to proactively supply. So maybe that means writing something down on the receipt, or maybe when transactions get imported into whatever system you are using, maybe you add something in the notes field that sort of describes it. But we want to make sure we are capturing these 4 key pieces of information. And there are a couple ways of doing that. One way is just in Google Sheets or Excel or Numbers if you're a Mac user and you like that. There's a lot of real powerful tools within these database systems that you can use to kind of sort and organize the data. You can also export data from your bank account so you don't have to retype all the information. We would want to export it in something called a CSV file. That's essentially putting it into Excel or Google Sheets form. And then you can sort of mix and match and reorganize the information within that database system. You can also do some planning. You can put it into different categories. These are really powerful tools, and Excel generally requires a subscription or a software purchase, but Google Sheets is free and remarkably easy to use, all things considered. Here's how I would set it up if you were setting up your own system in Google Sheets or Excel. You can see you've got the date column, the vendor or client or counterparty column, and the amount column. And then, of course, you've got the business purpose column. The only extra thing I would add is some sort of column that says category. And this is how I would organize the information and line it up to where it goes on your tax form. While you're in your Google Sheet, you maybe add a mileage log as well. There are also fantastic apps for tracking your mileage. Mile IQ is one of those, which is very, very good, works independently. You do have to enable location services, which isn't always a choice everyone is comfortable with, but it enables you to track business miles versus personal miles, which is fantastic. The other option is if you are using a software system. Almost all the software systems have apps that track your miles as well. But if you're setting up your own system in Google Sheets, I'd actually add a mileage log in there as well, just so you can keep track of everything. If you say to me, Elaine, I hate Excel in Google Sheets, that is a terrible choice. I do not want to use it. That is totally fine. There are some really great software options as well. Some of my favorites are listed here. QuickBooks kind of tends to be the gold standard when it comes to, tracking income and expenses. Simplify is one I also really like, and so is Wave. Now I noticed Melissa, I think it was Melissa, although it could have been Mandy, shared in the chat. Oh, I think it was Mandy. Mandy shared in the chat that, Mandy, you're already using QuickBooks, which is fantastic. And by being a QuickBooks user, it also gives you access to TurboTax, and then you can do magical imports so that everything lines up really nicely. And so Mandy's question was, do I need to hire a tax pro for help? I would say probably not, unless you really just feel like you want additional support. Personally, I think a savvy person who doesn't mind sort of keeping track of things and then importing it and sort of going through the TurboTax process can totally handle it. The software is designed to be really user-friendly, as you probably know if you've used it. So I do not think you have to hire a tax pro. Some people like to opt for sort of the audit protection that some of these companies offer for a little extra comfort. And then some people also like to work with a tax pro every couple of years just to sort of gut check some things that have changed. But I think if you're comfortable with QuickBooks and you're comfortable with the TurboTax product that goes along with it, I do not think you have to file or to hire a tax pro at all. And if you're a QuickBooks user, QuickBooks is one of those software systems that has the app and it has embedded mile tracking within it. And I think, Melissa, I'm sorry you missed the name of the mileage app. It's called Mile IQ, like, intelligence quotient, Mile IQ. That's the app. And I'm pretty sure it's free, although there might be a paid version as well. Mitch has a question as well. How do payment apps work as receipts for business expenses? And then Mitch goes on, for instance, if I paid studio rent via Cash App, is a screenshot of that payment with studio rent month per year an appropriate receipt? Yeah, I think that would work, Mitch. I think it'd be great if the screenshot sort of showed who you paid. It's even better if it's sort of a predictable amount every single month. That sort of makes it look obvious, like you're not just kind of making up expenses and calling them something, right? So that predictability, a screenshot like that is totally fine. A lot of the apps too, like Venmo or Cash App, some of the others, PayPal, they'll let you export the data. So you can almost just see it like in an Excel version, basically. That's also a good way to sort of just get it out of the app and get it into a place where you are keeping track of it. So hope that helps. Oh, Candace is a Wave user. Yeah, a big thumbs up endorsement of Wave in the chat. Wave is fantastic. It basically does the same thing QuickBooks does. A lot of people find it a little more intuitive to use. QuickBooks, for as wonderful as it is, isn't always super intuitive, so it does sometimes take some getting used to. Wave also has a free version, which is not true of QuickBooks. QuickBooks has a self-employed version, which I think is, $28-ish a month after you kind of go through all the discounted trial periods. And then they have a small business version, which is closer to like $33, $35 a month. They're both really great. Self-employed is designed to line up perfectly with the Schedule C categories. Small business gives you a little bit more freedom to kind of define your own categories, but I have folks that use both and really like both as well. I even have one person who is still using the old like software desktop version of QuickBooks that is no longer sold or supported. Almost everything has moved into a subscription model. But if you've got it and it still works, that is perfectly fine. Mandy has another question. Does paying last year's taxes count as a business expense this year? So Mandy continues, for example, I paid 2022 taxes in 2023. So when you're doing your taxes right now, do you count your tax payment as a business expense? You do not. I'm sorry. If you are paying like sales tax to buy supplies, I think, Mandy, you're a writer, so your supplies might be maybe a little bit more limited than a visual artist, but like sales tax like that is deductible in the cost of whatever you're purchasing, but you do not get to deduct your income taxes that you are paying, unfortunately. And then, okay, oh yeah, and Melissa shared that Venmo also downloads, you can download and export the data for sure, which is great. Thanks for layer it in the chat. As I said, there's such great experience out here. And while we're mentioning Cash App and Venmo, you might know that you're supposed to be using the business versions of those products if you are using them for your business. We also know that lots of people use them personally, in part to avoid paying fees, even though you're supposed to use the business version. But here's something that's going on with 1099s and those apps. So once upon a time, not all that long ago, the threshold for those apps sending out 1099s to users was $20,000 or 200 transactions. So that means if you use Venmo to accept payments from, say, customers, for example, and you collect more than $20,000 via Venmo or Cash App or PayPal, at the end of the year, Venmo, Cash App, PayPal, or any of the other payment apps will send you a 1099 that basically says, hey, this is how much money you collected through the payment app this year. Now, it's a special 1099. It's called a 1099-K. And the IRS has been strongly trying to persuade these payment apps to issue 1099-Ks at much lower thresholds. So the IRS passed new sort of regulations that required these companies to send out 1099-Ks for anyone who collected more than $600 in transaction through the apps. Now, that might be making you panic a little bit for a couple of reasons. Number one, you may have collected more than $600 through the apps. And secondly, you may have like business activity and then paying a friend for dinner all kind of mixed in the same app, which makes that reporting really, really messy. Now, the good news is the first year this was going to be enacted was going to be 2023, actually, but then the IRS delayed it by a year, which was nice. And so then we were thinking it was going to be effective for like right now, right? That you would be getting 1099s now, but it was delayed at least one more year. Thank goodness. The other thing the IRS has shared is that the new sort of threshold they're thinking about is $5,000 of activity instead of $600. Now, that is not final. We're going to see where all of this shakes out. But since you have another year and we're already talking about Venmo and Cash App, I might suggest that now is a really good time to clean up your record keeping a little, maybe so that you're only using one app for business purposes and maybe another app for personal transactions, or maybe that you just go ahead and get a business account if you are using those apps, and then just raise your fees or your selling prices or your rates to kind of capture and cover the fees that those apps are going to charge you. Because at some point, these platforms are going to start sending out 1099-Ks at a much lower threshold than $20,000. So I hope that wasn't too much of a technical sidebar, but it's definitely a good idea. Just keep your records clean. Mitch has a follow-up question about tax pros. If you pay to get your taxes prepared by a professional, can you deduct that as an expense? Mitch, it depends, and I'm sorry for a wishy-washy answer. Once upon a time, like before the Tax Cuts and Jobs Act, the answer was always yes. Software, tax pro, whatever tax fees you have as a person or as a business were always deductible. But after the Tax Cuts and Jobs Act, most of which went into effect in 2018, you could no longer deduct the personal cost of preparing your taxes, but you can deduct the business cost of preparing your taxes. So let's pretend you are going to use a platform like Free Tax USA or Tax Act or TurboTax, and it's going to be free to do the federal income tax and maybe say $20 to do your state income tax. But because you're running a business, you actually have to pay an extra $75 for the business version. That business portion would be deductible, but the cost to prepare your state income tax return would generally not be. That's a personal expense. Or if you're going to a tax pro, on their invoice, they should probably itemize out for you cost to prepare your personal tax return and cost to prepare your business tax return. That way you can deduct the business portion. Hope that helps. So we have a good endorsement for Wave. We have another quasi endorsement, maybe. I don't want to put words in Mandy's mouth, but for QuickBooks, but it's what I use as well. It's a great option. Simplify is the other platform that I'm really liking right now. It's nice, it's intuitive, it's seamless. It's not free. I think it's $3.99 or $4.99 a month, but for folks who are sole proprietors or maybe don't have separate accounts for their business, Simplify can be really good. It's a nice way. It allows you to kind of set up lots of different categories of income and also kind of personal expense categories and business expense categories. So that's a good option as well. And if you were a user of Mint, Mint has gone away. It is no longer an option. So, if you're looking for a replacement, these are some other replacements you might want to consider. And as you're thinking about retaining all that information exported from the apps or within QuickBooks or Wave or anywhere else, and also any of the receipts you have in PDF form or in sort of paper form, you want to make sure you're holding on to all of that information for a 7-year period. That's basically the year when the expense happens, and then a 6-year statute of limitations after that. And then after that, you can get rid of it, or you can just save it for your long-term archives. I really like if you are in a position to have a separate bank account for your business. That is not the reality for everyone. So if that's not your reality, don't worry about it. If you could have a separate credit card that you only use for business, that could be at least a first step to kind of separating things out. And if you're a sole proprietor, the only reason we have to separate or we want to separate is just to help the records be a little bit cleaner, right? So there is sort of that separation instead of having everything commingled. However, if you're someone who's like, nope, I like to rock the commingled moment, that is also perfectly fine, right? It just means your record keeping might take a little bit longer as you sort of tease out the business and the personal. If, though, you are someone with an LLC or an S corporation, you absolutely have to have that separation, right? Because that is a separate legal entity, and we don't want to sort of compromise any of the liability protection that might come from that separate legal entity. Melissa asks if anyone has a program for scanning in receipts that they like. And Melissa shares she's not a fan of the paper clutter. I totally hear you. I think feel free, anyone, to chime in the chat if you do have a system. Most of the apps, including Wave and QuickBooks, and I think also Simplify, will allow you to take a picture of the receipt and then attach it to the transaction. You can also do that just with your camera and then put all the pictures in a folder that's called receipts. You could also do that for anytime you buy something online, if you get sort of an emailed receipt, or if you sort of end up with emailed receipts through like Square transactions or something like that. You can just tag them in your inbox as receipts and then create one PDF at the end of the year, just so you're kind of hanging on to everything. But if other folks know, Keeper might be one. I don't know if anyone's used Keeper, but I think Keeper is an app where you can take pictures of your receipts specifically for tax purposes. So if anyone else has others, chime in the chat. Okay, so we were talking about how you're running a business, and the first thing was keeping books and records, right? So I think we're good on knowing we have to keep books and records. But that's not the only way you're running a business. The IRS also likes to see that you spend enough time on the activity to make it profitable. This means it's not like a once a year kind of thing, but it is something you are doing on a regular basis. Now, regular does not have to be full-time. It can be part-time or part-year. Let's say you're a muralist and you live in Ohio, you're going to have clear seasons to when you can and cannot be outside painting murals, right? So part-year type of work is totally fine. That still counts as a business. We just want to make sure there's some sort of regularity to what you're doing. The IRS will also look to see if you have the knowledge needed to make your business successful. That doesn't mean you have to know everything, but it helps if you've been trained in it, or you're building your expertise, or you're bringing in outside experts if there are things you don't know. And then lastly, it's always good to be able to show that you are making money from what you are doing, right? In fact, the IRS will assume that you are running a business if you show profit in 3 out of every 5 years, meaning your income is more than your expenses in 3 out of every 5 years. My dream for you is that every year would be profitable, but of course we know that's not always how it works in the arts. So if you find yourself in a situation where maybe you are not profitable in 3 out of 5 years, it's okay. There's a lot of documented tax court cases. Metz v. Commissioner is a really good one that basically go through these different examples of how taxpayers have shown that they are in fact still running a business, even if the business isn't super profitable every year or every 3 out of 5 years. So that's how we know we're running a business. If you are running a business, then you are entitled to deduct ordinary and necessary business expenses that you incur in an effort to earn money from your business, right? But you only get business deductions if you are running a business. So when we're thinking about these business expenses, we're thinking about ordinary and necessary costs that are effectively connected to your trade or business. So ordinary means common and accepted in your industry, and necessary means helpful and appropriate for your trade or business. The effectively connected piece basically means there's some sort of business purpose associated with the thing you are doing, right? So that's how a lunch with friends, which is a personal expense normally and not deductible, because personal expenses generally are not deductible. But if it's a lunch with friends that are also collaborators and you're talking about preparing for an upcoming show, that business purpose demonstrates that the lunch is effectively connected to your trade or business. It's preparation for an upcoming event to talk about a show or a repertoire or whatever you're doing, right? Then it becomes an ordinary and necessary business expense. So documenting that connection becomes really important, right? But remember, you are the one claiming that the expense is ordinary, necessary, and effectively connected to your trade or business. So that means because you are using it to reduce your taxable income, essentially, that means the IRS has the right to ask you questions about it, right? If you don't claim an expense, they will not ask you any questions about that. But if you do, it's your obligation to demonstrate how the expense is ordinary, necessary, and effectively connected to your trade or business if they ask, right? They might not ask, but we do want to make sure we are not committing tax fraud and just, adhering to the general intent of the law, which is that you are able to deduct expenses related to your business. I would not deduct everything imaginable that even has like a whiff of connection. I would be really intentional about things that really are ordinary, necessary, and effectively connected to your trade or business. Now, you put those deductions on Schedule C if you are a sole proprietor or if you are the only owner of an LLC. We call that a single member LLC. If you have an S corporation or if you're part of an LLC with multiple owners, you're filing a slightly different tax form. So it might look a little bit different, but basically all the same categories are showing up no matter what type of business you are running, right? So these are kind of the major ones that come up. Advertising. Some people put their website here. Some people use this if they are making, say, show cards for an event, or maybe they are paying to promote posts on social media leading up to certain events, any kind of things like that. I've seen people put like Linktree subscriptions in here as well, if that's a product you use basically on Instagram to be able to sort of redirect to multiple places. Some people think of that as advertising. Other people say, you know what, no, that's more of like a software subscription. And so folks will often put software subscriptions down here in this other expense section. And this is sort of the beauty and the complexity of the tax form, right? We've got some categories, and sometimes they're really good and they capture a lot of things for a lot of types of businesses. But it is absolutely true that you will likely need to have some of your own categories in this other expenses section. And that's basically where you just name your own category and then just be consistent from year to year. So if software subscriptions is one that makes sense for you, you put it in other, you put the total, and then in your record keeping system, make sure you have a category that's called software subscriptions so that you can match it up to your tax form. If you're deducting mileage, that goes under car and truck expenses. That's also where you would put parking expenses or tolls you might have, other types of car-related expenses. Melissa asked a question in the chat, what about childcare costs so that you can work? Childcare costs are not business expenses, which seems crazy, right? Because yes, why would we pay them, right, except to work? Although that's probably not true, right? There is a flavor of a business purpose there, but childcare costs are not deductible as business expenses. Where you might recapture some of that cost is through the child tax credit. So that's a separate place where we might capture some of that cost. But you know, that's not necessarily the deduction that lives here. And yes, I totally agree. It seems a little crazy. If you hire other people, they fall under contract labor, generally speaking. So let's say you're a musician and you perform with these 3 other people and you're the most responsible one. So you get all the money and then you pay the other people. That also means you're going to get the tax form at the end of the year. And so then you will deduct what you paid to the other individuals as contract labor. This is also true if you hire a copywriter for your website, or you hire people to help with install for a show. Maybe you hire a copy editor, or maybe you hire a social media person to kind of post things online for you. Any contractors you're hiring, the amounts you pay to them go here on line 11. And of course, if you are hiring contractors, you want to make sure there's a clear understanding with them about what they are doing and what you are going to pay them. So my dream scenario is that you have some sort of contract with them. It's also a really good idea to have them fill out a W-9 so that you have their legal name, their address, and their social security number, so that if you end up paying them more than $600 during the year, you are then very easily able to send them a 1099 at the end of the year. Because that's your obligation. If you are running a business and hiring contractors, you need to send them 1099s at the end of the year. And you know this process. You probably get dozens of 1099s yourself every year, right? Just like you receive them all, if you pay anybody more than $600, you need to send them 1099s as well. You can do that through Wave or QuickBooks, although it's not as cheap as I would like it to be through either of those platforms. My favorite way to send 1099s is through a website called track1099.com. It's TRACK and then 1099. So track1099.com. And then as long as you have the information from the W-9 and the amount you paid the person during the year, plus their email address, you can send out 1099s I think it ends up costing about $3.26 per 1099, which is one of the more affordable ways I've found of sending them out. I think if you're doing it through QuickBooks, usually it's $200, $250 or so to get the 1099 ability. I don't hire that many contractors, so for me, using track1099.com ends up being a better option. But don't forget to do that. The deadline for sending those out is January 31st, so that everyone has enough time to gather those 1099s and then file their own taxes for the year. Legal and professional services comes up here as well. This is where if you are hiring an accountant or an attorney or other sort of professionals to help within your business, those fees would go there. Office expenses tends to be kind of like supplies, not artwork supplies that often ends up here on line 22, but like office type of supply things. Printing and postage usually ends up here as well. And I have seen people put like software subscriptions within office expenses as well. That's okay. If you're someone who wants it on its own line, I'm also okay with that. Again, just try to be consistent from year to year. If you're renting out studio space or office space or any other sort of business property or storage space, that rental fee can go here. I mentioned supplies. Supplies for your artwork generally end up on line 22. If you are traveling, any travel costs are deductible, and so are business meals. Now, business meals can be meals where there is a business purpose. The example I gave earlier was collaborators dining out together and then, talking about an upcoming collaboration. Maybe you're going out to dinner with editors or sort of a team that you're putting together in advance of a book launch. Maybe you are meeting with potential labels or agents or managers, and you're meeting over lunches or something. All of those are business meals where there is a business purpose associated with the meal. And so you can report those meals here. Here's the catch though, only 50% of your total meal expense is deductible. And it doesn't matter how many people are at the meal or anything like that. It's just business meals are 50% deductible. And that's just one of those strange tax quirks and limitations. Why? Because generally, Congress doesn't want to incentivize people to take meetings over meals, right? So you get a deduction, but you can only deduct half of the cost. The other type of meals that fall under 24B are meals while you are in travel status. So let's pretend you are going to Cleveland for a writers' convention and you're going to be there for 3 or 4 days and you are eating by yourself while you're there. Sometimes you're eating with other people, right? Any travel meals that you are incurring are also reported on this line for deductible meals. So just be clear that meals in general, 50% deductible. We want there to be a business purpose. And if you are traveling away from home, your travel meals do count as that business purpose. Then we get to this last line, other expenses, and this is where we total up anything that you have put in your own categories. It all gets added together and then shows back up there on line 27A. As you are thinking about this, my suggestion would be, as you are sort of keeping track of things in your system, track everything that's business related, and then you and your accountant at the end of the year can kind of go through it and then figure out what to deduct or not. But if you have all the data, then you can kind of make that choice. Also, if you are using QuickBooks Self-Employed and it is really obvious where everything is going on your Schedule C, you probably don't need this kind of, map. But if you are using QuickBooks Small Business or Wave, I think Wave talks to Tax Act. I think that's sort of their partnership for the tax filing process. Or if you were using Google Sheets or Excel, you definitely want to create a map for yourself that says, okay, software and subscriptions ends up in part 5, or, UPS charges for shipping things ends up in office expenses, right? You want to kind of create a map that says, here's what I'm calling it in my system, and this is where I put it on Schedule C. You are not supposed to remember this from year to year, so having that kind of map can make your tax preparation life much easier. That's basically what your accountant would be doing. So if you're using QuickBooks and then your own tax prep software or any other system in your tax prep software, you want to have that map so that you can streamline your process. I will pause here to see if there are other deductions you are curious about that you want to make sure we cover. I'm scanning through. It looks like someone recommended Scannable to track receipts. That's a great resource, Mandy. Thank you so much for sharing that.
I did have a question.
Yes, please.
In terms of like doing theatrical production, a lot of folks that I know write off tickets to go see shows, they write off recordings that they buy, they write off scripts, all of those kinds of things. But I haven't been able to like find any depository. So you speak of like what is reasonable and customary, because like you said, I want to be deducting things, but I don't want to be deducting so much that I'm calling attention to that.
Yes, such a great question. I think depending on your creative pursuit, and you specifically shared theatrical production as the example, I think it's very reasonable to engage in research in the industry. So that to me absolutely means scripts that you are purchasing, and you should always be buying them instead of asking them for free from the writer, by the way. It also means probably tickets, attending different events. Where I think it gets a little interesting is to say, is absolutely everything you are going to research, or is some of it personal? And that's where I think it's a little bit of a judgment call on kind of what's the business purpose, because the business purpose might always be research. And it might also be, oh my gosh, my best friend is in this thing and I just want to go and support them. Or it's my anniversary and I want to go to this show. So I think it's okay to sort of say, no, this is business, this is research, because I really want to see this director's work. I want to experience this production from an audience perspective. I'm thinking about collaborating with this person, or I'm thinking about using this piece as an audition piece and I want to see it, right? I think the stronger the business purpose, the easier it is to really justify the deduction, right? So that's sort of when it comes to like theater kind of things. But it's also true for musicians, right? Who are probably regularly attending things, engaging with things, probably using something like Spotify. I think it's really easy as a professional musician to justify a Spotify deduction, particularly if you're researching repertoire or leaning into kind of different things like that. If you're a visual artist and you're using music in your installation work, I think there's a stronger argument there. If you're a visual artist or a writer and you just do your best work when you're listening to music, that feels less like a solid business deduction to me, just because it feels more like a personal preference rather than a business purpose. Now, that's not to say that no one has ever done that in the history of the world, right? But I think it sort of gets to this question of, is it ordinary? Is it necessary? And how is it effectively connected to your trade or business, right? Because the stronger that connection, the easier it is to defend as a legitimate business expense. The weaker that connection, the more it might feel a little less defensible sitting across the table from an IRS agent. Does that kind of help?
Thank you.
Yeah, absolutely. Absolutely. Ooh, so many good questions coming up in the chat. I'm so glad. When it comes to mileage, mileage is really interesting because I think you're on really solid ground if you are going from your primary place of business, and maybe that is your home, or maybe that is a separate office you have, primary place of business to a client or to a meeting and back feels completely deductible to me. Where it gets a little dicier is, let's say you have a place of business, like a co-working space you're renting, right? And you go from there to the client, and then from the client back home. Some people would argue that going from the client back home is more like commuting, right? To and from your primary place of business. Now, if your primary place of business is at your home, I think you're on much more solid ground to deduct the entire round trip cost. But go ahead and track it all, and then, see where it lands. Mitch is affirming research. Mitch also mentions art books and events, for sure, totally deductible. Exhibition fees, if you were going to see something, all of those things definitely fall into that research category. Professional memberships, definitely deductible. Those come up in all sorts of different ways. You could even argue it's a membership to the museum that, is part of your professional membership. Certainly memberships to any kind of professional organizations or anything you're part of where you are engaging with other people, getting resources, all those types of things. The only thing I would watch for on professional memberships is on your receipt or whatever statement they send you. Sometimes they will say a percentage or a certain dollar amount of your membership is used for lobbying purposes. If they say that on the receipt, that portion, whether it's a percentage or a dollar value, is not deductible. Why? Because we don't incentivize lobbying activities by giving a tax deduction for them. So, for example, I'm a CPA, I'm a member of the AICPA, and it costs, like $575 a year or so. And then when I get my statement, it always says $125 of your dues is spent on lobbying purposes. So I just carve that out from the deduction annually. I still report the full cost in my books and records because I still had to pay the whole thing. But then when I put the number on my tax form, I make sure that I am making that adjustment. The same thing could come up if you are a member of like a nonprofit or a collective or something like that. It is possible that your membership will be $300 and then they will say something like, the charitable value of your membership is $50 or something like that. So, you could watch for that language too. But it's definitely the lobbying piece that comes up in professional memberships. Candace has a question about grants. Grants are fantastic and they are taxable income to you. So Candace, let's pretend you get a $1,200 grant from GCAC, and let's pretend you plan to use it on purchasing photography equipment and lights and new lenses and things like that. The way that would show up on your taxes is you would live here on Schedule C, and up in the income section, you would have $1,200 of grant income that generally ends up just on line 1 here. So you would have $1,200 there. And then let's say you spent $1,000 on lenses. You would sort of report that here on line 13. And maybe you spent the other $200 on like lighting supplies or light bulbs or something like that. You'd probably put that here on line 22. So we have $1,200 of income, taxable income, but you also have $1,200 of expenses. So what happens is 1,200 minus 1,200 equals 0. So you don't end up paying taxes on the grant, even though it is taxable income to you, and you should report it on your business tax return. Great, great question. Alejandro asks about power tools like table saws that last for many years, but not forever. Fantastic question, Alejandro. For a table saw, and what did you spend on a table saw? Maybe like $2,500 or so? I'm guessing here. Maybe it's $2,500. Maybe it's more or less. Feel free to put it in the chat. The reason I ask is because, in general, if you are spending money on a piece of equipment that will last for more than 1 year, you have 2 choices. You may deduct the entire cost in year 1. That's called a Section 179 election, where you are basically saying, I choose to deduct the entire cost of the table saw in the first year. That is fantastic. You could also choose to depreciate the cost of the table saw, which basically means let's pretend you spent $2,500 on it, and let's pretend you think it's going to last you 5 years. You could decide to take a $500 deduction for the table saw in each of the next 5 years. So you're spreading the cost over time to better align with when you are using the table saw. Now, you are totally fine to do that. And maybe you want to do that because maybe you want to sort of spread that deduction out instead of having one big deduction in 1 year. Personally, I would deduct the whole thing in the first year because that's when you spent the money. So that's when I would want the tax deduction. Technically, the 179 limit is crazy, crazy high, but I will say it has to be sort of contextual within your business, right? So if your business is bringing in, I don't know, $30,000 a year, right? You probably would choose something like a $2,500 threshold or maybe a $5,000 threshold. And you would say anything under that amount, I'm going to go ahead and expense in 1 year. If it's more than that amount, maybe at that point you choose to depreciate. But it is kind of a flexible number that you would choose based on the materiality of your business. I hope that helps, Alejandra. So all such good questions. I don't think I missed any, but if I did, let me know. As you're going through this, kind of the key trip hazards that sometimes come up are, this idea of, are you really running a business? That especially comes up in very early years, maybe what we would call like pre-revenue years. And you want to make sure that you can demonstrate that you are in fact running the business. We also want to make sure that we're clear on personal expenses that are not deductible versus business expenses that are deductible, right? So we'd look for, aspirational research here. One of my favorite stories comes from a playwright who's amazing and I adore him. He is also a lifelong Yankees fan. And he told me he always dreamed about writing a play about the Yankees and he wanted to deduct his season tickets every year because one day in the future, he might write that play. And I would love to watch that play. I think it would be amazing. It is insane to think you can deduct season tickets for a lifetime as research for a thing you might write in the future, right? Totally different if someone has commissioned him to write the play or, there's a much stronger business purpose involved, but season tickets over your lifetime for something you hope to do in the future is real aspirational. So we want to be careful about that. We also want to make sure that the travel you might be deducting is primarily for the business purpose. So if your best friend is getting married and you're going to be in some really cool place for like a week, and you just happen to, pop into a gallery while you're there, that does not make the entire trip deductible, right? So we want to make sure you're clear with yourself on the primary purpose of the trip being for business purposes. Also, just be careful on the documentation, right? Make sure you're capturing the information that you need to capture. And Alejandro, at sort of that cost level, if you paid about $900 for it, or if, even if it was about $1,800 or what it's worth now, I would probably deduct the whole cost in the first year if it were me. So if you're running this business, you do get these deductions, which is awesome. Hopefully you're bringing in some money, right? And then you calculate this net business income. And this is the number where you have to pay self-employment taxes. And this is the part that usually surprises people when they are running their own business, because self-employment taxes are no joke. This is 15.3% of your net business income. This is a huge number. $7,000 of taxes on $46,000 of net income is a really big number, right? So definitely make sure you are preparing for that by setting aside, I usually recommend 30% of what you're bringing in, right? But absolutely making sure that you are at least covering 15.3% of your self-employment income. Question, and I sort of glazed over it. Sorry about that, Mitch. Mitch had a question about clarifying business use of your home. And I love talking about this. So thanks for sort of bringing me back to that. Business use of your home is a valid deduction, except the space within your home has to be used exclusively and regularly for your business purpose. And it's that exclusive piece that usually gets folks into trouble. So if it is a space that doubles as a guest bedroom, it is no longer deductible because that is not exclusively used for your business purpose. Or if it's a kid's playroom, or if it's also your kitchen table, right? All of a sudden, that is not exclusively used for your business purpose. The other thing I would watch out for is, let's pretend, and forgive me, Mitch, I don't know your creative discipline, but let's say you're a visual artist, and let's say you have a studio space at your home, and it is studio, right? It's not guest bedroom, it's nothing else, it's only studio. But let's say you also are a W-2 teacher, a professor at an arts college or in OSU's arts department, right? And let's pretend you teach at home from your studio. All of a sudden, that space is no longer exclusively used for your business purpose. Why? Because now you're using it for your W-2 job. And remember, there are no deductions associated with your W-2 job. So we want to be really careful about that exclusive use of the portion of your home. Now, if you are exclusively using a space within your home, you are on solid ground. It is a deduction that will get additional scrutiny because it's one that people sometimes try to be a little aggressive with. So the IRS knows it's one it's going to scrutinize. It is also all by itself. So it's way down on line 31, which is below all the other expenses. So you can't sort of bury it in with other rental property or something like that, right? So it is one that will be scrutinized, mostly because people don't always adhere to the letter of the law on that. But you can absolutely deduct a portion of your rent or mortgage, utilities, insurance, anything you need to sort of maintain the space, as long as you meet that exclusive and regular test. So let's say you have a room, it's 100 square feet, and your whole house is 1,000 square feet. You would calculate 10% of your home is exclusively and regularly used for your business. And then you would take 10% times your rent or mortgage, all of your utilities, your Wi-Fi, homeowners insurance. I've also seen there was a great tax court case where, like, I think it was like co-op fees or like homeowners association fees were lumped in and the person deducted the business portion of that. So any of those costs, I think you're on solid ground, but just make sure you meet exclusive and regular. Hope that helps. Faria has another question. What can and can't we list when traveling for professional development? So professional development, assuming the primary purpose of the trip is business related, you get travel to and from there, whether it's on a train or driving or airfare, however you're getting from where you are to where you'll be and back. You also get lodging while you're there, and then you get meals while you're there, individually or sort of with groups. If you have other like parking fees, if you have admission to the professional development, all of that is deductible. So it's pretty good. Anything to get you to and from, and then covering you while you're there. Oh, here's a good question. How wealthy do you have to be to do all the fun tax evading things rich people do, like keeping all of your money in foreign tax havens or having shell companies? And what is a shell company and how can I use one to make doing taxes more exciting? I love this question. I think taxes are just exciting enough as they are. And with those new anti-money laundering rules, shell companies are slightly less interesting now, perhaps. But, the real answer is, there are interesting tax things to do kind of at all levels. The idea of sort of massive tax shelters, setting aside anything illegal, right? But the idea of massive tax shelters typically comes into play when your income comes from like not salaries or like earned income, but when it comes from investment income, because that's when you're dramatically lowering your tax rate. That's what Warren Buffett complains about every year, because he generally around tax time will post that he pays a lower effective tax rate than his administrative assistant. And it drives him crazy because most of his compensation is from investment gains rather than a salary. And so those are taxed differently. But the other exciting things you can do are, identify all of these business expenses as long as they're ordinary and necessary, and then kind of lean into any of the tax incentives that come up in these adjustment categories. Melissa asks about cell phones. Do you have to have two to deduct them? No, unlike business use of your home, there is no exclusive and regular use for your cell phone. In order to deduct any of it, you want to make sure at least 50% of it is for your business. And then you just gauge your usage. You can do that through, screen time apps or any other types of kind of trackers that show you how you're using your phone. And you can estimate the percentage of business use. Remember, if you are an employee of someone else and you use your phone, that is not business use. That is not deductible. Also, anything personal is not deductible. But generally speaking, you can probably get to at least 50% business use and maybe higher depending on how you use it. Such good questions. I do want to remind you again about self-employment tax because it's a big number and it adds up. And you get to deduct a portion of it. And Alejandro, in this adjustments to income section, these are where some of those additional deductions or incentives that come through tax policy could show up as well. But then, of course, everybody gets the standard deduction. We're assuming this person is a single individual. So their total income, right? $90,300 when we add these things together, that is automatically reduced by their standard deduction. And again, here are the numbers for 2023. They go up each year. And here's where I really want to make sure you're clear on the choice between the standard deduction or itemizing your deductions. This is an either or choice, so you pick the one that's bigger. For 91% of taxpayers, the standard deduction is bigger than whatever they would list on Schedule A. And your standard deduction is different from the business deductions you have on Schedule C or Schedule E if you are an S corporation, right? So you get both business deductions and then either the standard deduction or itemized deductions. I can't tell you how many people say, oh, I don't track my expenses because I don't itemize. And that makes me so sad, right? Because your business deductions live over here on Schedule C, and you get the standard deduction on top of that, right? So definitely make sure you are claiming everything you are entitled to. And then, Alejandro, there are these other adjustments, right? One of my favorite ones is making a contribution to your individual retirement account. That is a place where you can have an extra deduction to incentivize you to save for your retirement. As your business grows, you might even consider opening a solo 401k in your business, which can increase the amount you can contribute even more. But then there are a couple of other things that show up here as well. Having a health savings account is a good deduction. You have to be in a high deductible plan, and that is not always an option for folks, but this is a good deduction. Also, if you are self-employed and you have no other access to insurance, you can deduct your insurance premiums here, which is nice. Also, if you have student loans and you are paying interest on those student loans, there's a deduction for that interest down here as well. So that's not going to kind of magically make taxes go away, but all of these additional things really can add up. So we take all of your income from the W-2 job, from your business after expenses, we adjust it for anything we can adjust it for, and then we get to this taxable income number at the very end. That's when we calculate the tax, and we calculate the tax at each different level, right? We have a marginal tax system. So as your levels get higher, the tax rate gets bigger. So for this individual, their total federal tax is going to be $9,917. How do we get that? They pay 10% tax on the first $11,000. That's $1,100 of tax. Then they pay 12% on the next $33,700 and some change. So that's another $4,000. And then they pay 22% on the extra amount that's in this total category or this third bucket, right? So that puts them to a total federal tax of $9,917. But of course, we have to add their self-employment tax, right? Because that gets added in there as well. So what they're going to end up owing for federal taxes is $17,000, which is crazy high. And then if they live in a state with tax, this is 5%. That's generally higher than what you will experience in Ohio. And if they live in a city with a tax, this is 3%, which is generally higher than what you will pay in Columbus. We add those taxes. So they ultimately end up paying like $22,000 in tax. We take that total amount that they actually end up paying, right, in taxes, and we compare that to what they paid in during the year. Maybe that was from withholdings, or maybe they were making their own quarterly estimated taxes. When we look back, this person only had withholdings on their W-2 job. And you can see 44,000 is what they thought, or their employer thought they were earning. They pretty much doubled that. And if you go back to these tax levels, right, their employer was only withholding to get to this 12% number. All of that extra income pretty much ended up getting taxed at that 22% level. So this person is under withheld simply because of the math of how this works, right? Now, that doesn't make them feel any better when they owe this huge amount, right? But they are really, really under withheld for the year, which means when they file their tax return, they're going to have to pay $15,395. And they could lower it by adjusting their withholdings. They can ask their W-2 job to withhold extra from each paycheck, or they can make some of those quarterly estimated tax payments throughout the year. And so those quarterly estimated tax payments, I love. If I were working with this person, I would probably look at these numbers with them. And then I'd probably say, okay, if you want to do extra withholdings, let's figure out what it is. If they ended up owing $13,600 of federal tax and they were paid twice a month-ish, that would be an extra $567 of federal tax withholdings. Or every time they collected income from their business, they could set aside about 21% of that for taxes. I'd take state and local taxes into account too. So maybe what does that end up being, like 23, 24%? I would round up and say definitely set aside 25% every time you make a sale, or adjust these withholdings. I know that's like a lot of math, but it is an example of how you can kind of use the tax return, especially if you sit down with your accountant and kind of look at it and go through it to help you plan more for the future. Denise, thank you for being so patient. I see your hand. What is your question?
Hi, good evening.
Hi.
I just had a brief question pertaining to what you mentioned earlier. Does the room, like your art studio or home office, I have a room specifically devoted to that instead of me renting out real estate or, a commercial space. I work remotely at home. So are you saying 100% of that space has to be devoted? Like, for example, I don't do this, but let's say I wanted to have half of that room. This was a good idea because a lot of people like to work out at gyms, or some people like to work out at home. If I had it partially a gym and I was doing some workout sessions in there to exercise a few minutes a day, and then I also was doing business related endeavors in that same office, are you stating that that's not that doesn't apply to what you mentioned earlier, that the room has to be 100% devoted to that space and creating new art or creating works or doing whatever the business is, regardless of graphic design or, you know, is that what you're stating? Or it could be partial.
So the way I would do that is you cannot deduct the portion that would be the gym in your example. So let's pretend that room is like 100 square feet and your whole house is 1,000 square feet. I would take half of that room as your exclusive and regular business use space. So maybe you say, okay, 50 square feet is the portion that is exclusively and regularly used for business. So then you would do 50 square feet divided by 1,000, which I think I can't do mental math, right? But your percentage would be lower then, right? So it wouldn't be the whole room. It would be just the portion that's exclusively used. Does that kind of make sense?
Yeah, so how would I deduct? I'm sorry, repeat one more time. How would, if you wanted to deduct that, that would be,
Yeah, so you would just measure basically half the room. So instead of taking the
oh, I
whole
see.
room as
The
the
whole
deduction,
room.
yeah, you would just take half of it because half of it is a gym, right? Not business use. But the half that is, you would still be entitled to that deduction.
I see. And is it, are you dividing per se what you would make in half from that deduction, or no, it's just the room you're dividing?
You're just dividing the square foot of the room, and then take the square foot of the room that's business use and then divide that by total square footage of your house. And then that gives you the percentage of your home costs that are associated with your business. So then you
I
would take
see, I
that
see.
percentage times your rent or your mortgage and your utilities generally, because those are like the costs for maintaining the house, right? So if it's
Yes.
5% is business use, then you would have a 5% deduction.
I see. I got you 100%
Yeah,
now, following along. Yeah,
nice.
I got it. And I do devote 100% of that time in that space. I don't use it for anything else. It could be multi-purpose or multifunctional, but I think for now, I got what you're saying. So I could just measure the whole thing. But if I ever run into in the future, I just measure half if I use it for something else in the future.
Exactly. Yep. Or
Okay.
put the treadmill in your, basement or like living room or something, right? To like preserve and
Yeah,
protect that deduction. Yeah. And
exactly.
I think Alejandro had a little bit of a similar question in the chat. If you are claiming that deduction, right, the IRS has the right to ask you questions about the deduction. So that could be sending you a letter that says, would you provide documentation of the space? And in that case, Denise might draw up a copy of the floor plan and sort of show the space, maybe have some pictures of the space to sort of show how it is exclusively and regularly used. And then the IRS can say, cool, looks good. Or they can say, I don't know. And then they could come and inspect it. They don't just show up, right? You know they're coming. But if you are claiming it as a deduction, you are basically offering the right to have that deduction examined, and you're capable of providing the information to defend that deduction. So I hope that's helpful. I know it's complex, right? And nuanced. We are officially out of time. If I missed anything, I hope you will let me know. What's the big new thing this year is the beneficial ownership information reporting. Don't sleep on that. Recognizing different types of income, deducting those ordinary and necessary expenses, keeping track of everything in records is so good. And then my loving suggestion would be to set aside 30% of what you bring in for your business. Even though our example was maybe closer to 25%, if you have a little extra, there's your retirement fund for the year, or an extra emergency fund. So if you can get in that habit, it gives you a little bit of wiggle room. I will end with gratitude for all of you for being here, for your wonderful questions, for your great discussion, and huge gratitude to Greater Columbus Arts Council for supporting these kinds of conversations. I will follow up via email with a copy of the recording and a copy copy of the slide deck because I know we went through it all really fast. And then lastly, I would love to draw your attention to the second GCAC tax thing we're doing this year. We're actually doing in-person conversations around taxes starting Saturday, February 17th. I'm going to be hanging out at the main library in room 3A. I'm going to be there answering tax questions and then also walking through this process for people as you're gathering things, as you're navigating these software systems or different conversations, and as you're planning for next year. So if that's of interest to you, if you want to come hang out and ask more tax questions, that's where I'm going to be over a handful of Saturdays in February and March. Thank you so much for being here. Thank you for everything. And I will look forward to seeing you the next time our paths cross. Have a great night, everyone.